හොඳයි ඉතින් අදත් හැමෝටම ආයුබෝවන් කියලා ප්‍රාර්ථනා කරනවා. ඉතින් අද අපි අරන් ආවේ ඔයගොල්ලන්ට අපේ ෆයිනෑන්ෂියල් මැනේජ්මන්ට් සබ්ජෙක්ට් එකේ පේපර් ඩිස්කෂන් වල 2018 බැච් එකට තිබ්බ පේපර් එක ඩිස්කස් කරන්න. ඉතින් මේකෙත් කලින් වගේ මම කතා කරන්නේ තියරි ඇස්පෙක්ට් එක විතරයි. මේකෙත් මම කියන්නම් ඔයාලට මේකෙත් තියරිස් වලින් අපිට ලකුණු 40ක් ලකුණු 50ක් වගේ ප්‍රමාණයක් කවර් කරගන්න පුළුවන්. ඉතින් ගණන් හදන්න දුර්වල කෙනෙක්ට එහෙම නැත්නම් ගණන් හදන්න බැරි කෙනෙක්ට මේ තියරිස් වලට ලියලා හොඳ රිසල්ට් එකකට යන්න පුළුවන්. මොකද ඔයගොල්ලන්ගේ අසයින්මන්ට්ස් වලට හොඳ මාර්ක් එකක් තියෙනවා. ඉතින් තව අසයින්මන්ට් එකක් අපිට හම්බෙන්නත් තියෙනවා. ඉතින් මේ අසයින්මන්ට් දෙකෙන්ම අපිට ලකුණුත් එක්ක මේ පේපර් එකෙන් ගන්න ලකුණු ටිකත් අපිට එකතු කරගත්තොත් අපේ පාස් මාර්ක් එකට අපිට එහාට ගිහිල්ලා අපිට මේ සබ්ජෙක්ට් එක ගොඩ දාගන්න පුළුවන්. හොඳයි. එහෙනම් ඉතින් අපි එමු වැඩි කතා නැතුව අපේ paper discussion එකට. So first we are going to give the answers for the question number 1. So under there first question is differentiate finance from financial management. ඉතින් ඔයාලට මතක ඇති අපේ අනිත් paper තුන් දෙකේම අපි කතා කරපු paper දෙකේම මේ question එක තිබ්බා. ඒ කියන්නේ අනිවාර්යයෙන්ම මේක සාමාන්‍යයෙන් ගොඩක් වෙලාවට එන question එකක්. ඉතින් අපි එහෙනම් බලමු මේකටත් අපි කලින් වගේම answer එකක් build up කරලා තියෙනවා. ඉතින් ඒ answer එකට අපි යමු. Okay, so according to our model answer, finance and financial management are closely related but have distinct focuses within the field of business and economics. Here's how they differ. First one, finance. Finance is a broad term that encompasses the management of money, investment, and financial resources. It deals with various aspects related to the acquisition, allocation, and utilization of funds. Finance involves analyzing financial markets, assessing investment opportunities, managing risks, and making financial decisions. It encompasses both personal finance, which focuses on individual finance planning and investment, as well as corporate finance, which deals with financial management within organization. Then financial management specifically refers to the activities, techniques, and processes involved in managing an organization's financial resources. It is a subset of finance that focuses on the efficient and effective use of funds within a company. Financial management involves making decisions related to capital budgeting, capital structure, working capital management, financial analysis, and financial planning. The primary objective of financial management is to maximize the value of company and optimize the use of financial resources to achieve the organization's goal. In summary, finance is a broader discipline that encompasses various aspects of managing money and investments, while financial management specifically deals with the management of financial resources within an organization. Financial management is a subset of finance that focuses on making strategic financial decisions to maximize the value of the company. Then let's move to the next question. What are the key attributes for successful companies? Here also I have given a big kind of a detailed answer, but you don't need to go into the further. But for the study purpose, I have built this answer. Right. Successful companies tend to possess certain key attributes that contribute to their achievements and longevity. While specific attributes may vary across industries and contexts, here are some commonly observed attributes of successful companies. First one, vision and strategy, then strong leadership, customer focus, adaptability and innovation, a strong corporate culture, operational excellence, talent management, financial strength, social responsibility. Vision and strategy. Successful companies have a clear and compelling vision for their future. They develop a well-defined strategy that aligns with their vision and set a roadmap for achieving their goals. This includes identifying target markets, competitive advantages, and growth opportunities. Strong leadership. Effective leadership is critical for success. Successful companies have leaders who inspire and motivate employees, make strategic decisions, and create A positive organizational culture. They provide direction, set goals, and encourage innovation and continuous improvement. Customer focus. Successful companies prioritize customer satisfaction and understand the importance of building strong customer relationships. They invest in understanding customer needs, delivering high quality products or services, and providing exceptional customer experiences. Adaptability and innovation. Successful companies are adaptable and responsive to changing market conditions. They embrace innovation and continuously seek ways to improve their products, services, and processes. They are not afraid to take calculated risks and explore new opportunities. Strong corporate culture. A positive and strong corporate culture is crucial for success. Successful companies foster a culture that values integrity, collaboration, open communication, and employee empowerment. They promote a sense of belonging and a shared purpose among employees. Operational excellence. Successful companies focus on operational efficiency and excellence. They have streamlined processes, effective supply chain management, and strong financial controls. They continuously strive for cost optimization, productivity improvements, and quality enhancement. Talent management. Successful companies recognize the importance of attracting, developing, and retaining top talent. They have robust human resources strategies in place, invest in employee development, and create a supportive work environment. They foster a culture of learning, provide growth opportunities, and reward performance. Financial strength. Successful companies maintain financial stability and discipline. They manage their finances prudently, maintaining strong cash flow management, and make informed financial decisions. They have a solid financial foundation that supports growth, innovation, and withstands economic downturns. Social responsibility. Increasingly, successful companies embrace social responsibility and sustainable practices. They consider the impact of their operations on society and the environment. They engage in ethical business practices, support community initiatives, and demonstrate corporate citizenship. It's important to note that success is multifaced and can be measured in various ways. Different industries and contexts may require additional attributes for success. Nonetheless, these key attributes provide a foundation for building and sustaining successful companies. Then the third question. Briefly explain investment decisions and financing decisions of a business firm. Investment decisions. Investment decisions, also known as capital budgeting decisions, involve determining how a company allocates its financial resources to acquire or invest in different projects, assets, or opportunities. These decisions are crucial as they have long-term implications for the company's profitability and growth. The main objective of investment decision is to maximize shareholder wealth by selecting projects or investments that generate positive net present value or have a high return on investment. Key considerations in investment decisions include first one, project evaluation, cost benefit analysis, capital budgeting, risk assessment, timing of investments. Project evaluation. Evaluation and analyzing potential investments opportunities to assess their profitability, risks, and alignment with the company's strategic goals. Cost benefit analysis. Comparing the cost of investment against the expected benefits, such as anticipated cash flows, revenue growth, cost savings, or market expansions. Capital budgeting. Allocating limited financial resources among competing investment projects based on their expected returns, risk profiles, and strategic importance. Risk assessment. Assessing the risk associated with investments, including market risk, industrial risk, technological risk, and project specific risk. Timing of investments. Considering the timing of investment projects and their impact on cash flows, market conditions, and competitive dynamics. Financing decisions. Financing decisions involve determining how a company raises funds to finance its operations, investments, and capital requirements. These decisions focus on selecting the optimal mix of financing sources, such as debt and equity, and determining the capital structure of the company. The objective of financing decisions is to ensure the company has adequate funds at a reasonable cost while balancing risk and return. Key considerations in financing decisions include capital structure, debt financing, equity financing, dividend policy, and risk management. Capital structure. Determine the proportion of debt and equity in the company's capital structure. This involves evaluating the trade-offs between the cost and benefits of debt financing and equity financing. Debt financing. Deciding on the appropriate level of debt and assessing different sources of debt financing, such as bank loans, bonds, or lines of credit. Considerations include interest rates, terms, covenants, and the impact on the company's financial risk. Equity financing. Evaluating options for raising equity capital, such as issuing new shares or attracting venture capital or private equity investments. This involves assessing dilution, control considerations, and the cost of equity. Dividend policy. Determine the distribution of profits to shareholders in the form of dividends or retaining earnings for reinvestment. Considerations include the company's financial position, cash flow requirements, and shareholder expectations. Risk management. Assessing the financial risk associated with different financial options, such as interest rate risk, liquidity risk, or credit risk. Managing these risks through appropriate hedging strategies or financial instruments. Both investment decisions and financing decisions are critical for long-term success and financial health of a business firm. Investment decisions involve deploying financial resources into productive assets or projects, while financing decisions focus on raising the necessary funds to support those investments. The two decisions are interconnected, as an investment decisions influence financing needs and financing decisions impact the cost of capital and financial flexibility available for investment. Why is social responsibility important for business? Social responsibility is important for business for several reasons. Enhanced reputation, stakeholder satisfaction, risk management, employee engagement and retention, long-term sustainability, regulatory compliance and public expectations, innovation and competitive advantage. Enhanced reputation. Embracing social responsibility can help build a positive reputation for businesses. When a company demonstrates a commitment to ethical practices, environmental sustainability, philanthropy, and community engagement, it earns the trust and respect of customers, employees, and stakeholders. A strong reputation can lead to increased customer loyalty, positive brand perception, and a competitive advantage. Stakeholder satisfaction. Socially responsible practices contribute to the satisfaction of various stakeholders, including employees, customers, investors, and the local community. By addressing social and environmental issues, businesses can create a supportive and inclusive work environment, meet customer expectations for ethical products and services, attract social conscious investors, and foster goodwill among local communities. Risk management. Engaging in social responsibility helps businesses manage and mitigate risk. By proactively addressing environments, social, and governance issues, companies can minimize reputational risk, regulatory risk, and legal liabilities. This can help protect the company's brand, avoid costly legal disputes, and maintain positive relationships with regulators, customers, and the public. Employee engagement and retention. Socially responsible practices can contribute to higher levels of employee engagement, job satisfaction, and retention. Employees are more likely to feel motivated and proud to work for a company that demonstrates a commitment to social and environmental causes. This can lead to improved productivity, talent attraction, and employee loyalty. Long term sustainability. Social responsibility is aligned with the principles of sustainable business practices by considering the long term impacts of their actions on society and the environment. Business can contribute to the overall well being of communities and ensure the availability of resources for future generations. Sustainable practices such as reducing carbon footprint, conserving resources, and promoting fair trade help create a more resilient and sustainable business model. Regulatory compliance and public expectations. Governments and regulatory bodies increasingly emphasize corporate social responsibility through regulations and reporting requirements. By complying with these regulations and meeting public expectations, businesses can avoid penalties, maintain positive relationships with authorities, and adapt to changing societal norms. Innovation and competitive advantage. Social responsibility can drive innovation and provide a competitive advantage. Businesses that proactively addresses social and environmental challenges often discover new marketing opportunities, develop innovative products and services, and differentiate themselves from competitors. Embracing social responsibility can foster a culture of innovation and creativity within an organization. In summary, social responsibility is important for businesses as it contributes to a positive reputation, stakeholder satisfaction, risk management, employee engagement, long term sustainability, regulatory compliance, and innovation. By integrating social responsibility into their business strategies, companies can create shared value for themselves and society at large. Fifth question, what kind of agency problem arises when the firm is raising capital from the market? When a firm raises capital from the market, an agency problem known as principal agent problem or agency cost can arise. The principal agent problem refers to the conflict of interest between shareholders, the principals, and the management, the agents of a company. In the context of raising capital from the market, the following agency problems can arise: information asymmetry, adverse selection, moral hazards, agency costs. Information asymmetry. Shareholders may face challenges in obtaining complete and accurate information about the company's financial health, investment opportunities, and risks. This information asymmetry can lead to conflicts if management provides incomplete or misleading information, potentially affecting the decisions of investors. Adverse selection. Adverse selection occurs when companies seeking capital from the market might present themselves in a more favorable light than the actual situation. This can lead to mispricing of securities or investors investing in companies with higher risks than they were aware. Moral hazard. Moral hazard arises when managers, after raising capital, do not act in the best interest of shareholders. They may engage in risky activities, misuse funds, or make decisions that benefit themselves at the expense of shareholders. This behavior can lead to misalignment of interests between managers and shareholders. Agency cost. The process of raising capital from the market incurs various costs, including underwriting fees, legal fees, and administrative costs. Additionally, ongoing monitoring and control mechanisms may be necessary to ensure that management acts in the best interest of shareholders, resulting in additional cost. To mitigate this agency problem, various mechanisms and practices can be implemented, such as improved corporate governance practices, including independent boards of directors, effective monitoring systems, and transparent reporting to align the interest of shareholders and management. Enhanced disclosure and transparency requirements, enabling investors to inform decisions, effective regulatory frameworks, and oversight to ensure compliance with laws and regulations, active shareholder engagement and voting rights to hold management accountable. By addressing these agency problems and implementing appropriate mechanisms, firms can enhance investor confidence, reduce information asymmetry, and align the interests of shareholders and management in the capital raising process. Briefly explain the role of stock market as an element of financial system. The stock market plays a crucial role as an element of financial system by facilitating the buying and selling of stocks and other securities. It serves as a platform where investors, both individual and institutional, can trade shares of publicly traded companies. Here are some key roles of the stock market. Facilitating capital formation. The stock market enables companies to raise capital by issuing stocks or going public through an initial public offering or IPO. This process allows companies to sell ownership stakes to investors and raise funds for various purposes such as expansions, research and development, and acquisitions. By providing access to capital, the stock market promotes economic growth and development. Providing liquidity. The stock market provides liquidity to investors by allowing them to buy and sell securities easily. Investors can convert their investments into cash quickly and efficiently, promoting flexibility and facilitating portfolio diversification. This liquidity encourages investment and enhances market efficiency. Price discovery. The stock market is an essential platform for price discovery, determining the fair value of security. The forces of supply and demand in the market lead to the establishment of market prices based on investors' perceptions of a company's future prospects, financial performance, and risk factors. This price discovery mechanism provides important information for investors, analysts, and companies. Investment opportunities and wealth creation. The stock market offers individuals and institutions the opportunity to invest in a wide range of securities such as stocks, bonds, exchange trade funds, or ETFs and derivatives. It allows investors to participate in the growth and success of companies, generating returns on their investments and build wealth over time. It also promotes diversification by offering investment options across various sectors and geographies. Risk management and hedging. The stock market provides avenues for investors to manage and mitigate risk through various investment strategies. Investors can diversify their portfolios across different stocks and asset classes, hedge against market fluctuations using derivative instruments, or employ trading techniques to manage risk exposure. This risk management function helps investors protect their investment and navigate uncertain market conditions. Corporate governance and transparency. The stock market promotes corporate governance by establishing regulations and requirements for listed companies. Publicly traded companies are subject to disclosure and reporting obligations, which enhance transparency and accountability to shareholders and the public. This transparency fosters investor confidence, improves market efficiency, and reduces information asymmetry. Economic indicators. The stock market serves as an important barometer of the overall health and sentiment of the economy. Market indices such as the S&P 500 or the Dow Jones Industrial Average are used to indicators of economic performance and investor sentiment. Movements in stock price and market indices can reflect broader economic trends impacting customer and investor confidence. In summary, the stock market plays a vital role within the financial system by facilitating capital formation, providing liquidity, enabling price discovery, offering investment options, managing risk, promoting corporate governance, and serving as an economic indicator. Its efficient functioning contributes to the growth and stability of economy as a whole. Now let's move to question 2, part number 1, part A. Investments you made today generate cash flows at different time intervals in the future. Explain why those cash flows at different time intervals cannot be considered as they are. Cash flows at different time intervals cannot be considered as they are due to the concept of time value of money. The time value of money recognizes that the value of money changes over time due to factors such as inflation, opportunity cost, and the potential to earn returns by investing or using money elsewhere. Therefore, cash flows occurring at different points in the future cannot be directly compared or aggregated without considering their present value or future value. Subpart B, briefly explain the alternative methods available for make them comparable. Present value or discounting, future value or compounding. Discounting. This method involves discounting future cash flows back to their present value using an appropriate discount rate. The discount rate reflects the time value of money and the risk associated with the cash flows. By discounting future cash flows, their values can be expressed in terms of their worth in today's dollars, allowing for meaningful comparisons and evaluations. Future value or compounding. Alternatively, cash flows occurring at different time intervals can be brought to a common point in the future by calculating their future value. This involves compounding the cash flows forward using an appropriate interest rate or return. Future value calculations help determine the accumulated worth of cash flows at a specific future point in the time. Net present value. The net present value method combines both discounting and summing the present value of all cash flows associated with an investment or project. By subtracting the initial investment or cost from the total present value of future cash flows, the NPV represents the net value for profitability of the investment. Positive NPV indicates that the investment is expected to generate returns greater than the discount rate, while negative NPV suggests a potential loss. Internal rate of return or IRR. The internal rate of return is discount rate that makes the present value of cash inflows equal to the present value of cash outflows. It represents the rate of return an investment is expected to generate. The IRR can be compared to the required rate of return or cost of capital to assess the feasibility and attractiveness of an investment. These methods enable the comparison and evaluation of cash flows occurring at different time intervals by considering their present values, future values, or net values. By accounting for the time value of money, decision makers can make informed investment choices and assess the profitability and viability of investment opportunities. Question number 3, part A. Suppose a management of a company is wondering whether to issue stocks or bonds to raise capital for an expansion. Briefly discuss the pros and cons of two types of sources of funds for an organization. Issuing stocks and bonds are two common methods for companies to raise capital, each with its own pros and cons. Here are the key considerations for stocks and bonds. Issuing stocks, let's discuss the pros. Equity financing, by issuing stocks, the company raises funds through equity financing, which does not require repayment of the capital. Investors become shareholders and participate in the company's ownership, potentially aligning their interest with the company's long-term success. Potential for capital appreciation. If the company performs well, the value of its stock can increase, allowing investors to benefit from capital appreciation. This can attract investors seeking potential high returns. Cons. Dilution of ownership. Issuing new stocks leads to dilution of existing shareholders' ownership stake in the company. This means existing shareholders' proportional ownership and control over the company decrease. Dividend obligations. If the company pays dividend, issuing stocks increase the number of shareholders entitled to receive dividends. This places an additional financial burden on the company and may reduce funds available for other purposes, such as reinvestment or debt repayment. Issuing bonds. Fixed interest, the pros, fixed interest payments. When a company issued bond, it promises to make regular interest payments to bondholders. This fixed obligation provides predictability and stability in the company's financial obligations. No dilution of ownership. Unlike stocks, issuing bonds does not dilute ownership or control existing shareholders. Bondholders do not have voting rights or ownership claims on the company's assets. Then the cons. Debt financing. Bonds represent debt financing, which means the company has an obligation to repay the principal amount to bondholders at maturity. This increases the company's overall debt burden and adds interest expenses. Interest payments. Bond insurances, sorry, Bond issuances require the company to make regular interest payments to bondholders regardless of the company's financial performance. Failure to meet interest payments can lead to default and damage the company's creditworthiness. In summary, issuing stocks provide the advantage of equity financing and the potential for capital appreciation, but may result in dilution of ownership and dividend obligations. On the other hand, issuing bonds offers fixed interest payments and avoids dilution of ownership, but increases the company's debt burden and interest obligations. The choice between stocks and bonds depends on the company's specific financial needs, its risk appetite, and the preferences of investors in the market. Second one. When you invest in a portfolio, part of the risk of individual assets can be diversified. Thus, one cannot expect a reward for bearing the total risk of individual assets. Do you agree? Explain your answer highlighting the relation between risk and return of any asset according to the capital assets pricing model. I agree with the statement that part of the risk of individual assets can be diversified in a portfolio. Diversification refers to the practice of investing in a variety of assets with different risk and return characteristics to reduce overall portfolio risk. By combining assets that are not perfectly correlated, the fluctuations in the returns of one asset may be offset by returns of another asset, resulting in a reduction in the portfolio's overall risk. The relationship between risk and return is a fundamental concept in finance, and the capital asset pricing model, or CAPM, is a widely used framework to understand this relationship. According to the CAPM, the expected return of an asset is determined by its beta, which measures its sensitivity to systematic risk or market risk. Systematic risk refers to the risk that cannot be diversified away. As it affects the overall market or specific market segment, it includes factors such as economic conditions, interest rate changes, and market sentiment. Unsystematic risk, also known as idiosyncratic credit risk can be diversified away through portfolio diversification as it pertains to specific to individual assets or companies. The CAPM states that the expected return of an asset is equal to the risk-free rate plus a risk premium, which is proportional to the asset's beta multiplied by the market risk premium. The market risk premium reflects the compensation investors require for bearing systematic risk. Therefore, according to the CAPM, investors should only be rewarded for bearing systematic risk, as unsystematic risk can be diversified away. When investing in a well diversified portfolio, the unsystematic risk of individual assets is reduced and investors are primarily compensated for bearing systematic risk. In summary, the CAPM suggests that investors should not expect to be rewarded for bearing the total risk of individual assets that can be diversified away. Instead, they should focus on systematic risk of their investments, which is reflected in the assets beta and the associated risk premium. Diversification allows investors to reduce unsystematic risk and build portfolios that are more efficient in terms of risk and return. Differentiate the capital market line CML and security market line SML of the capital asset pricing model. The capital asset pricing model CAPM includes two important lines. Those are the capital market line or CML and the security market line or SML. While both lines are used in the CAPM framework, they serve different purposes and represent different concepts. Here's a brief differentiation between the CML and SML. Capital market line CML. The CML represents the risk return trade off for a well diversified portfolio that includes both risky assets and a risk free asset. It illustrates the combinations of expected return and standard deviation or risk that an investor can achieve by adjusting the allocation between risk-free asset and the risky portfolio. The CML is a linear relationship that starts from the risk-free rate and extends to the tangency point with the efficient frontier, which represents the optimal risky portfolio. The slope of the CML reflects the risk premium, representing the additional return investors require for taking on additional risk beyond the risk-free rate. Security market line or SML. The SML, also known as the characteristic line, is a graphical representation of the CAPM equation. It shows the expected return of an individual security or portfolio as a function of its beta, which measures its systematic risk. The SML is a straight line that intersects the y-axis at the risk-free rate and has a slope equal to the market risk premium. According to the CAPM, the expected return of security is determined its beta multiplied by the market risk premium plus the risk-free rate. The SML provides a benchmark for evaluating whether an investment offers an appropriate expected return relative to its systematic risk. In summary, the CML represents the risk-return relationship for a well-diversified portfolio that combines a risk-free asset with risk assets. It shows the trade-off between risk and return for different asset allocations. On the other hand, the SML illustrates the expected return of an individual security or portfolio based on its systematic risk, as measured by beta. It provides a framework for pricing securities and assessing their expected returns relative to their systematic risk. Question number 4, part 1. Briefly explain the relationship between bond coupon rate, yield to maturity, and the bond price. The relationship between bond coupon rate, yield to maturity or YTM and bond price can be summarized as follows. Bond coupon rate. The coupon rate of a bond refers to the fixed annual interest rate that the bond issuer promises to pay bondholders. It is typically expressed as a percentage of bond's face value. The coupon rate determines the periodic interest payments that bondholders will receive throughout the bond's term. Yield to maturity, or YTM. Yield to maturity is the total return anticipated by investor if a bond is held until its maturity date. It represents the annualized rate of return, taking into account the bond's current market price, coupon payments, and the difference between the purchase price and face value. YTM reflects the average rate of return an investor can expect from the bond if all coupon payments are reinvested at the YTM rate until maturity. Bond price. The bond price refers to the market price at which a bond is bought and sold. It represents the present value of the bond's future cash flows, which include the periodic coupon payments and the final payment of bonds face value at maturity. The bond price is influenced by various factors, including interest rates, market conditions, credit ratings, and the bond's time to maturity. The relationship between coupon rate, YTM, and bond price can be summarized as follows. When the bond coupon rate is equal to the YTM, if the coupon rate of a bond is equal to its YTM, the bond is said to be priced at par. In this case, the bond price will equal to its face value. For example, if a bond has a face value of 1000, a coupon rate of 5%, and YTM of 5%, the bond price will be 1000. When the bond coupon rate is higher than the YTM, if the coupon rate is higher than the YTM, the bond is said to be priced at a premium. In this case, the bond price will be higher than its face value. Investors are willing to pay a premium for higher coupon payments, resulting in a higher bond price. When the bond coupon rate is lower than the YTM, if the coupon rate is lower than the YTM, the bond is said to be priced at a discount. In this case, the bond price will be lower than its face value. Investors are willing to accept a lower coupon payment in exchange for a discounted purchase price, resulting in a lower bond price. Overall, the relationship between bond coupon rate YTM and bond price is such that when the coupon rate is equal to the YTM, the bond is priced at par. If the coupon rate is higher than the YTM, the bond is priced at a premium. And if the coupon rate is lower than the YTM, the bond is priced at a discount. The bond price adjusts based on the relative attractiveness of the bond's coupon payments compared to the prevailing market interest rates. Part 2. The impact of interest rate change on the prices is greater for a long term bond than a short term bond. Do you agree? Explain your answer with an example. Yes, I agree with the statement that the impact of interest rate change on the price is generally greater for a long term bond compared to a short term bond. This relationship is known as interest rate risk or price sensitivity to interest rates. Here's an explanation with example. When interest rates change, the price of a fixed rate bond adjusts to bring its yield in line with the prevailing market rates. The price and yield of bond have an inverse relationship. When interest rates rise, the price of existing fixed rates bond tends to fall and vice versa. The impact of interest rate change on bond prices influenced by two factors: the bond's time to maturity and its coupon rate. Let's consider two bonds, bond A and bond B, with different maturities. Bond A long-term bond with 20 years to maturity. Bond B, a short-term bond with 5 years to maturity. Assuming both bonds have the same coupon rate, let's say 5%, and interest rate in the market increase by 1%. For bond A, long-term bond, due to its longer maturity, bond A is expected to interest rate changes for a long period. The impact of 1% increase in the interest rate will have a more significant effect on the bond A price. The price of bond A will decrease more than that of the bond B, assuming all these remains constant. For bond B, the short-term bond, as a short-term bond, bond B has a short term to maturity. Therefore, its price will be less affected by interest rate changes compared to bond A. The price of bond B will still decrease, but the magnitude of the decrease will be relatively smaller compared to bond A. This example illustrates that long-term bonds are generally more sensitive to interest rate changes compared to short-term bonds. The longer the time to maturity, the higher the interest rate risk. This is because long-term bonds expose investors to longer period of uncertainty and potential reinvestment risk, as the fixed coupon payments received over time may be reinvested at lower rates in a rising interest rate environment. It's important to note that the relationship between interest rate changes and bond prices is more nuanced and can be influenced by other factors such as market conditions, credit quality, and investor sentiment. However, as a general principle, long term bonds tend to have greater price sensitivity to interest rate changes compared to short term bonds. Required rate of bond ratings issued by rating agencies and bond ratings are issued assigned after analyzing the factors of risk bonds. Briefly explain the factors that could affect the default risk of bond issued by organizations. The default risk of bonds refers to the probability that the issuer of a bond will fail to make the promised interest payments or repay the principal amount at maturity. Several factors can influence the default risk of bonds issued by organizations. Here are some key factors that can affect the default risk. Financial health of issuer. The financial strength and stability of the issuer play a significant role in determining the default risk. Factors such as profitability, cash flow generation, leverage ratio, debt coverage ratio, and overall financial performance of the organization are considered. A financially healthy issuer with a strong track record is likely to have a lower default risk compared to a financially weak issuer. Industry and market conditions. The industry in which the issuer operates can impact the default risk. Certain industries may be more susceptible to economic downturns or face specific challenges that increase the default risk. Market conditions, including competition, regulatory changes, and technological advancements, can also influence the default risk. Business risk and operating environment. The nature of the issuer's business and its operating environment can affect default risk. Factors such as market demand, competitive landscape, product diversification, market position, and management effectiveness are considered. Stable and diversified business operating in favorable environments tend to have lower default risk. Debt structure and obligations. The structure of the issuer's debt, including its level of leverage, debt maturity profile, and debt convenience, can impact default risk. High levels of debt, short term debt obligations, and restrictive debt covenants may increase the default risk. On the other hand, a well structured debt portfolio with manageable debt levels and longer term obligations can lower default risk. Credit history and ratings. The issuer's credit history and credit ratings assigned by rating agencies are important indicators of the default risk. A strong credit history with a good track record of meeting financial obligations and a favorable credit rating indicate a lower default risk. Conversely, a history of missed payments or lower credit ratings suggests a higher default risk. Macroeconomic factors. Macroeconomic conditions such as GDP growth, inflation rates, interest rates, and Currency stability can impact default risk. Economic downturns, high inflation, or volatile interest rates can increase the default risk for issuers. Country-specific factors. The political, legal, and regulatory environment of the country in which the issuer operates can influence default risk. Factors such as political stability, rule of law, transparency, and government policies can impact the issuer's ability to meet its financial obligations. It's important to note that these factors interact with each other and their relative importance may vary depending on the specific issuer and market conditions. Credit rating agencies consider these factors when assigning bond ratings to provide investors with an assessment of the default risk associated with a particular bond issue. When the capital market is efficient, it will reflect fair value of securities at all times. Briefly explain the three forms of market efficiency, highlighting the set information needed to make the market efficient under each form. The concept of market efficiency suggests that financial markets quickly and accurately reflect all available information in the prices of securities. There are three forms of market efficiency, each based on the set of information required for the market to be considered efficient. Weak form efficiency. In weak form efficiency, the current prices of securities fully reflect all historical price and volume data. This implies that analyzing past market data such as price trends or trading volumes will not enable an investor to gain an advantage in predicting future price movements. To make the market efficient under weak form efficiency, all publicly available historical information needs to be reflected in current price of securities. Semi-strong form efficiency. In semi-strong form efficiency, the current prices of securities reflect all publicly available information. This includes not only historical price and volume data, but also information from news releases, financial statements, analyst reports, and any other information that is publicly accessible. To make the market efficient under semi-strong form efficiency, all relevant public information needs to be incorporated into prices of securities. Strong form efficiency. In strong form efficiency, the current prices of securities reflect all information, both public and private. This means that even insider information, which is non-public and known only to a select few, is fully reflected in the prices of securities. If the market is efficient under strong form efficiency, no individual or group of investors can consistently achieve above average returns based on private information. In summary, to achieve market efficiency under each form, the following sets of information are needed. Weak form efficiency, semi-strong form efficiency, strong form efficiency, weak form efficiency. All publicly available historical prices and volume data. Semi-strong form efficiency, all publicly available information, including historical data, news releases, financial statements, analyst reports, and other publicly accessible information. Strong form efficiency, all information, both public and private, including historical data, public news, financial statements, financial reports, as well as insider information known only to a selected few. It's important to note that achieving perfect market efficiency is a theoretical ideal, and real world markets may exhibit varying degrees of efficiency. The level of efficiency can be influenced by such as market participants' behavior, information dissemination mechanisms, transaction cost, and the speed at which information is processed and incorporated into prices. Question number 5. Part 3. Briefly explain aggressive and conservative working capital policy in terms of financing. Aggressive and conservative working capital policies refer to different approaches adopted by companies in managing their short-term financing needs related to working capital. These policies determine the extent to which a company relies on short-term financing sources to fund its day-to-day operations. Here's a brief explanation of aggressive and conservative working capital policies in terms of financing. Aggressive working capital policy. Under an aggressive working capital policy, a company aims to minimize its investment in current assets, such as inventory, accounts receivable, and prefers to finance its short-term needs using short-term financing options. The primary objective is to keep the level of current assets as low as possible to optimize the use of available funds. This approach allows the company to have lower carrying costs for maintaining current assets and potentially higher returns on invested capital. Aggressive working capital policy typically involves the following characteristics: minimal investment in current assets. The company maintains low levels of inventory, tight credit terms with customers, and efficient collection of receivables to reduce the amount of tied up capital. Relies on short term financing. The company relies heavily on short term loans, lines of credit, or trade credit from suppliers to meet its working capital requirements. Higher risk and potential profitability. While this policy can lead to cost savings and improved profitability due to reduced carrying cost, it also carries higher risk, especially if the company faces unexpected disruptions in its cash flows or market conditions. Conservative working capital policy. Under a conservative working capital policy, a company takes a more cautious approach by holding higher levels of current assets to ensure smooth operations and reduce the risk of liquidity shortages. The company finances its working capital needs through internal funds or long term financing sources rather than relying extensively on short term borrowings. Key characteristics of conservative working capital policy include higher investment in current assets. The company maintains high levels of inventory, extends more regular credit terms to customers, and allows for longer collection periods to ensure sufficient availability of working capital resources. Reduced reliance on short term financing. The company prefers to use internal funds, retained earnings, or long term loans for funding working capital requirements, reducing its dependence on short term borrowings. Lower risk and increased stability. This policy provides greater stability and reduces the risk of financial distress since the company has sufficient liquidity and a buffer to handle unforeseen events or market fluctuations. However, it may result in higher carrying costs and lower short term profitability due to the tied up capital. Overall, the choice between aggressive and conservative working capital policies depend on various factors such as industry characteristics, business cycle, company's risk appetite, profitability objectives, and access to financing sources. It is important for companies to strike a balance between efficient utilization of working capital and managing the associated financial risk. Question number 6, part 2. What is residual dividend policy? Residual dividend policy refers to an approach followed by companies to determine the amount of dividends to be distributed to shareholders after fulfilling all investment and capital expenditure requirements. Under this policy, dividends are paid only from the residual or leftover earnings after the company has retained sufficient funds to finance its growth opportunities and meets its financial obligations. Here's a brief explanation of key features of the residual dividend policy. Investment and capital expenditure requirements, retained earnings, dividend distribution, flexible dividend payments. Investment and capital expenditure requirements. The company first identifies its investment needs and capital expenditure requirements, which include funding new projects, expanding operations, acquiring assets, and maintaining a strong financial position. These requirements are essential for companies' growth and long-term sustainability. Retained earnings. After allocations funds for investment and capital expenditures, the remaining earnings or profits are considered as retained earnings. Retained earnings are the portion of earnings that are not distributed as dividends but retained within the company to strengthen its financial position and support future growth. Dividend distribution. Once the investment and capital expenditure needs are met, the company evaluates the amount of retained earnings available for distribution to shareholders as dividends. The dividend amount is determined by subtracting the retained earnings requirement from the total earnings. The remaining funds are distributed to shareholders as dividends. Flexible dividend payment. The residual dividend policy allows for flexibility dividend payments. The dividend amount may vary from year to year based on the company's earnings and investment requirements. If the company's earnings are higher, it may result in higher dividends for shareholders. Conversely, if earnings are lower or investment needs are higher, dividend payments may be reduced or even eliminated. The objective of the residual dividend policy is to prioritize the funding of growth opportunities and financial obligations before distributing dividends to shareholders. By retaining earnings for future investments, the company aims to enhance its competitiveness, expand operations, and create value for shareholders in the long run. It is important to note that the residual dividend policy is just one of the approaches followed by companies, and different companies may adopt different dividend policies based on their specific circumstances, financial positions, and strategic objectives. So, with that, we have come to the end of discussing our past paper for the MBA batch 2018. ඉතින් ඒත් එක්ක අපි 2018 බැච් එකට දීපු ෆයිනෑන්ෂල් මැනේජ්මන්ට් පේපර් එක ඩිස්කස් කරන එක අවසානයට ආවා. ඉතින් තව අපිට එක පේපර් එකක් කතා කරන්න තියෙනවා 2017 පේපර් එක. ඒ පේපර් එකට අදාළ මොඩල් ආන්සර්ස් උත් මම ඉක්මනින් දාන්නම්. එහෙනම් එතකන් ඔබට සුබ දවසක්. Thank you very much.